President Trump visited the Federal Reserve yesterday, and the memes are already rolling in. Now, if you haven't been paying attention, President Trump and Fed Chair Jerome Powell have somewhat of a contentious relationship. You see, Trump thinks interest rates should be lower. He points out, which is true, that the United States interest rates are 1, 2, sometimes 3% higher than almost every other developed nation. Trump, of course, wants those rates to come down and down quick, yet Jerome Powell has been cautious to cut rates, and it's understandably why. Not saying he's right, I'm saying it's understandable why. You see, Jerome Powell and the rest of the Federal Reserve Board has been wrong every step of the way for the better part of the last decade. When COVID hit, they printed trillions and trillions of dollars. In fact, 80% of the dollars in circulation, 80% of the dollars in existence since this country was founded in 1776 were printed between 2020 and 2023. Well, that massive influx of money into the supply caused record inflation. You can't dump $5 trillion in the American people and not expect prices to go up. Anybody with a elementary understanding of economics knows that. Everyone apparently except Jerome Powell and his cronies of the Fed, who said famously that inflation would be transitory. That's a fancy Ivy League way of saying temporary. And of course they were dead wrong. Not only was it not temporary, it was much higher than they ever saw coming. Inflation hit 6, 7, 8%. And because of that, to fix the problem, which they essentially caused, they ratcheted up interest rates at one of the fastest paces in history. In 2022, the interbank lending rate went from 0.25% to 4.5% inside of a year. Huge, huge run. And we saw that affect every element of the economy. Of course, mortgages went from that honey hole 2.5%, 3% rates up to 6.5%, 7%, 7.5%. The rates increased on auto loans and personal loans and everything in between. That, of course, caused the economy to somewhat contract. And that's really the whole goal of raising interest rates or cutting rates, is to fuel or slow the economy. It's how they control inflation. It's the only tool they have. Well, the thing about that is when you raise interest rates, it also harms the stock market. Now, for more than a decade, there has been an inverse correlation between stock prices and interest rates. This chart you're looking at here is a reflection of that. On the top, we have the S&P 500 index, and on the bottom, we have the 10-year government bond yield. And typically, these two move in inverse fashion. So when interest rates are trending down, in this case from 3 to 1.5, stock prices tend to trend up. When the Federal Reserve, realizing they've caused once-in-a-generation inflation, then has to ramp up interest rates, and they accelerate from 1.25 to 4, well, that caused this bear market that we experienced in 2022. And this has pretty much always been the case for obvious reasons. You see, every dollar in the world, every investment dollar is chasing yield. Sure, we have different time frames, different risk tolerances. Someone in retirement with a nest egg already built may be looking for a steady 4, 5, 6% a year, while a kid who's 24 might be taking massive risks trying to make 20 or 25%. But the same holds true. And what happens is when you cut interest rates, it fuels stock prices because the landscape is no longer as competitive. You see, if you can put your money in a bond and make 5% a year, in order to entice you to give up that 5% guaranteed rate, you need to have a much higher earnings rate from stocks. This is known as the earnings yield, just how much they earn per share divided by the share price. That's the earnings yield. It's like the inverse of the PE ratio. If this is over your head, don't worry about it. But basically, if you're going to get a fixed income investor to take his 5% dollars and put them in stocks, which are more risky, he needs to be seeing an earnings yield of 7, 8, 9%. So when interest rates then go down, and now instead of making 4 or 5%, he's making 2 or 3, well, then even a 4 or 5% yield in stocks is very attractive. And so the price of those stocks rises as rates come down because the necessary earnings yield, what those stock earnings need to yield in order to be competitive over bonds, decreases. And so if you got a company making $1 a share, trading at $10, a $10 share price, the yield is 10%, 1 over 10. Well, if now bonds are paying 2%, they only need to yield 5. The same dollar of earnings, but the stock can double to 20. And so now it's yielding 5%. So nothing has changed at the company, but it can achieve a higher value, a lower earnings yield, and still be competitive. The opposite is also true. When interest rates go up, like we saw in 2022, and people who have been used to 0.25% interest in their savings account can suddenly get 4.5%, 4.75% yield from a money market account or local bank, well, that looks pretty attractive. And if stocks are to compete with that, they need to come way down so that the yield on those earnings is then much, much, much higher. Okay, so that's generally the inverse relationship between these two. However, we're beginning to see that relationship unwind under President Trump, and here's why. Now, President Trump is a bold man. He makes bold promises, bold threats. Sometimes he follows through with those, but other times he doesn't. And what we found in the first 6 months of his presidency, the precedent he has set, is that he often does not follow through with those threats. First, it was Canada and Mexico. He threatened monstrous tariffs on them to stop, of course, mass migration, but also the inflow of fentanyl. And then before the deadline hit, he said, I'm going to extend it 30 days. I'm going to extend it 60 days. They've come to the plate. I'm going to back off. He threatened massive tariffs on every country on the globe and then pulled all those back before the deadline. Recently, he's threatened to fire Federal Reserve Chairman Jerome Powell. Now, many argue he does not have the power to do that, and they're right. It is not explicitly outlined, but he can fire the man for cause. And my understanding is he was somewhat rallying the Republican troops to see if he had the support to do it, building a case to fire Jerome Powell for cause, saying the $2.5 billion renovation on the Federal Reserve facilities was a misuse of funds. And I can see the case. I mean, the Fed has done nothing but devalue your and my dollars since World War I. So the fact that they deserve a $2.5 billion renovation, little nuts to me. But nonetheless, here's where we are today. What's happening in the market where we used to get a big reaction from a Trump threat of tariff, or I'm going to do this with interest rates, or money printing, or borrowing, those reactions are now muted. You see, investors, both domestically and overseas, have learned to somewhat discount Trump's bold threats, his bold statements. They don't have the faith that he's going to follow through with them, so they see no reason to rebalance or reallocate multi-billion-dollar portfolios on what is all likelihood going to be just another empty threat that never results in anything. But here's what I think is going to happen next year and why this could be something we've never seen in 100 years. Now, there's another Fed meeting coming up in September. Many analysts believe Jerome Powell's finally going to cut interest rates by about 0.25%. I tend to agree. He's got a lot of heat on him right now. He's got a target on his back from the President of the United States. If he cuts just a little bit, 25 basis points, number one, the inflation data is there to support that decision, so it's not going to blow back on him. Secondly, it buys him a little bit of time. He gets Trump off from trying to threaten his position, and he can probably fill out his term. But Jerome Powell's term officially ends in June or July of 2026. And let me give you a little spoiler right now. President Trump is not going to offer him another term in that position. Whether he gets him out of office early or he replaces him with someone else, come July 2026, there will be a new person, a new chairman of the Board of Federal Reserves, the Federal Reserve Board. And Trump gets to appoint that person. Whether or not he can fire him, it's up for debate. But he does get to appoint the new Fed chair. And make no mistake, Trump will absolutely appoint someone who aligns with and agrees with his agenda. He is only going to appoint someone he is confident will quickly and aggressively cut interest rates. And so here's where the big shock, I believe, is going to come in 2026. Powell has been very conservative. He continues to be. No wonder. The guy's been wrong at every turn. Of course he's scared to cut too fast. He caused record inflation. He didn't want it to ramp back up. Powell may cut once more. Who knows? But it's going to be little minuscule 0.25% cuts. But come July, the new chair of the Federal Reserve, I can almost guarantee you, is going to want to come out strong. He's going to want to impress President Trump, who appointed them. And I believe He's going to make the largest interest rate cut in the history of this country. Never since the founding of the Federal Reserve in year 1914, never has the Fed cut rates by more than 100 basis points in a single meeting. There's been 0.25%, 0.5%, a couple of 1%, but never more than that. The market knows that. No one even thinks it's feasible we'd get a 100 basis point cut. But who can you think of? What person in a position of power has a long history and even a love of doing things that have never been done before, of shocking, bold movements? You guessed it, President Donald J. Trump. So what I think he's going to do is a first. I think you're going to see at least 100, if not 125 or 150 basis point cut to interest rates, especially if Powell only cuts once between them. And when that happens, you're going to see a massive spike in a lot of asset classes. You're going to see the price of stocks go way, way, way up, especially real estate investment, trust, and other interest rate sensitive stocks. You're going to see a huge boom in housing and construction. Remember, if you're a home builder, if you build commercial spaces, if you build giant production facilities that run into the billions of dollars, every 0.25% or 0.5% interest rate cut saves you tens of millions of dollars on the bottom line. That's the whole reason it stimulates the economy. And we're all guilty of that. When rates are at 3 and 4%, you're much more likely to borrow and build and expand. It's essentially free money. And Trump is the ultimate builder. He's the chief builder. And his biggest point of pride is the growth, health, strength of the economy. And so this is a decision that's going to be hard to argue with, because a massive interest rate cut, one, is going to save us interest on the new debt the government writes. So no side can really argue with that. It's going to bring down mortgage rates, car loan rates, personal loan rates, credit card rates, saving the American consumer. It's going to stimulate the economy in massive ways as companies go to expand and build and construct and grow and borrow money to grow. And so I don't think it's going to get any credible blowback that could stop him from doing this, other than the fact that it could, in fact, trigger inflation to ramp back up. But let's all be honest. They're never going to solve the inflation problem. As long as they're borrowing $2, $3, $4 trillion every single year, as long as our national debt is $37 trillion and climbing, it's only going to get worse. It doesn't matter if it's Democrats in Congress. It doesn't matter if it's Republicans in Congress. They all print, they all borrow, they all keep the bombs dropping. Let's not kid ourselves and think that some hero is going to come in and suddenly balance the budget. It's never going to happen. They're never going to stop spending. It is an inevitable crisis that will be massive inflation. The government is forced to print their way out of the huge debt hole they've created over the last 30 years. I can't fix that. You can't fix that. It is inevitable. Is it coming tomorrow? No. Next year? No. But 5, 10, 15 years, we're going to start seeing it. Politicians, especially presidents, are judged based on what happened during their term. We look back over that 4-year period. Is our life better or worse? Were prices higher or lower? Was my income more or less? Was my interest rate higher or lower? Was the stock market higher or lower? And regardless how you feel about Trump, I don't think he's a whole lot different. Obviously, he wants the best for Americans. I think he wants deep down the best for people 5, 10, 20 years down the road. But the great motivating factor and the reason these guys do what they do in order to get reelected is for short-term results. And so for that reason, I think you're going to see massive, massive cuts to interest rates. I think you're going to see a huge explosion in stock prices in 2026 and potentially 2027. I think you will finally have a chance to refinance your mortgage at probably 4.75 to 5.5%, albeit possibly the last time for the next couple of decades. But all of this will start with a new Federal Reserve chairman who massively cuts interest rates, and then the mechanics of the free market will take over, as they always have.